there's a lot to cover and only 45 minutes to do it in, so we'll let people join and pick up as we go through. So welcome everyone to our webinar today. This is our second webinar in the series, which we'll talk through in a minute. This one's all focused on capital allocation in R&D, and specifically looking at portfolio reviews and the role of those. Your speakers today are myself, David Hartley, and Simon. Both of us have worked in R&D in biopharma companies for a number of years. We've both been intimately involved in portfolio management and portfolio reviews and hence capital allocation. And this is a topic that we're both really passionate about. And so we're excited to see so many people today interested in the topic and also joining us on this journey. Today's session is part of a series that we're going through. The last session that we did was looking at strategy and how corporate strategy translates into R&D strategy and portfolio strategy and some of the challenges with that. Today, we're really talking about how that strategy becomes reality in our capital allocation decisions. We'll describe what we mean by capital allocation in this context to start with. We will go through a case study. Simon will take us through a case study at Roche before talking through in detail the portfolio review, the role of it, how it works, and how that operates as capital reallocation in action. As a reminder, from a process perspective, this webinar will be recorded. You can ask questions at any time via the chat. We will try and answer them as we're going through the session, but we'll also try and save a little bit of time at the end if we can in order to answer any outstanding ones. Any questions that we don't have a chance to get through today, we will try and follow up either with individuals or the group as appropriate. The slides and a recording of the session will all be shared after the session. So as I mentioned, this is part of a series. The last webinar that we did was looking at strategy. Today's on capital allocation. We are going through 6 different lenses in this webinar series, talking about how you make R&D spend defensible. The next one will be on portfolio planning, and we'll talk a little bit more about that at the end of the session. So with that, I will hand over to Simon to start talking us through capital allocation.
Thank you very much, David. So what does capital allocation really mean? It's about deciding where capital, or money, if you will, is deployed across various categories to create long-term shareholder value. So if you are the CEO of a biopharma company, there's really only a handful of ways to spend the money, simply put, and those you can see here at the bottom of the slide here. So of course, you can, on the right-hand side here below, you see this other capital uses. So we like often to give back to shareholders, so that can be dividends or share repurchases and also debt repayment. But today we're focusing on this growth reinvestment. So of course we can pour money back into the R&D engine, and we can also spend capital on external innovation, business development. But just to show here that obviously the R&D pipeline competes with capital across the organization. One example from Eli Lilly, their latest quarterly earnings call, where they show their investors, shareholders, this is how we actually distribute the capital in this company. And you see R&D is the biggest chunk. And then there's a category called capital investments. You need a lot of factories to get the GLP-1 produced. Business development, we also acquire companies, molecules. And then at the bottom, you see returned, giving back to shareholders today. So that's an example of how a capital allocation works inside a company. And many of you will be working within portfolio management functions. But before we actually see capital going into the pipeline or portfolio, it's actually traveling through 3 layers of decisions. So it starts at the very top, those 5 categories I showed you before. And part of that will then go into R&D. But R&D is more than just R&D pipeline. There's also, people, organization, technology platforms, labs with light on, and so on. But the part of the R&D pipeline part, you see that's where we will focus our attention mostly today. What are the sort of R&D portfolio choices we should make in the company? So I will not spend time on this slide. Just a reminder that last time we covered what makes a good strategy. I'll just leave the link here for you to to check if you want to have a look at. We did cover this triangle or pyramid last time, which we call our strategy stack. And just as a reminder, we have this, what we call the intent layer. What is the overall direction of the company, of the R&D organization? And then we have the portfolio control layer. So that's where we translate from intent layer to the portfolio layer and further down to the operational layer. And today we'll be focusing on this portfolio control layer, and of course making sure it's connected upwards and downwards in this pyramid framework we have here. So we have what we call our 2 laws of R&D capital allocation. The first one is that strategy shapes the R&D portfolio, or it should shape the R&D portfolio, so that the direction of travel is from the strategy into shaping the R&D portfolio. But on the other hand, you can at any time look up at a company's pipeline and you can infer what is actually the de facto strategy that company is operating under today. So that's what we call the 2 laws of R&D capital allocation. And here we'll go over a small case study in the following slides. And here's a small mental model we'd like you to keep in mind. And we have that red star shaped thing on the left. So there's some kind of big trigger. Let's say there's a new CEO, new CSO. Often that triggers a strategy refresh. Let's look at where we are actually going with the company. New rule for capital allocation, how we're going to spend capital in the company. And then the middle box, you see this R&D capital allocation framework. We need some kind of rules or tools to translate from strategy into portfolio and portfolio reshaping. And that's what we want to show and illustrate with the next case study here. And you see the blue arrows at the bottom. That's how we, in practice, see the 2 laws of R&D capital allocation working. So the case study we picked for you is Roche and their new pharma strategy, which is now a couple of years old, which we think really illustrates well how strategy connects strongly to an R&D portfolio action. So if we go back and this, you can take a look at their full investor material from their pharma day in 24. And here's just one slide which we picked, and we think this is a good one because it really shows how to make a strategy translatable from the strategy towards the pipeline. And as we the call outs here, you can see they are time bound, and there's also a quantified aspiration. So like we covered in the previous webinar, I mean, trying to be number 1 in biopharma, that's not a strategy. So here we have a quantified aspiration, and even they provide some further guidance for how to translate it into a portfolio shape. So that's a good starting point for a strategy. And then we need some kind of framework to make that operational. And Roche introduced this infamous framework, which she called the bar. And as you can imagine, it's basically setting what is the bar or hurdle rate for having molecules entering or exiting the portfolio. And there's something about, of course, the scientific strengths and also the focus and value across the assets. And here you can then see, so we have the strategy refresh, we have a R&D capital allocation framework, the bar, and here you can see over time how the portfolio has changed. So you can see how molecules are entering, that's the green bars here in the bridge, and then the red ones are molecules leaving. And you can see that it's actually moving across a few years here from more than 80 assets to 66. So that's the focus part of the reshaping. And then you see on the right-hand side, you see portfolio value, which was a declared objective for reshaping the portfolio, that average peak sales is going up, and that's also the total portfolio value as a metric is also increasing. So that's an example of R&D portfolio reshaping in action and how it traveled from the strategy refresh. And here's just plotted on top, the model I showed you before. And with that, I will hand it over to you again, David.
Thanks. So someone there has described an instance where there has been a significant event which has caused the need for a strategy refresh and therefore this dynamic reallocation of capital. But in practice, that's not the only way that organizations and the only time that organizations will need to be moving their money. Also, what we see is that there's this operating model of the need for continuous portfolio realignment. So you can imagine that after the activity that Simon has described has happened, you've done a portfolio prioritization and optimization. You're then in the process of operationalizing that. As those projects and as the portfolio moves on, inevitably things change. You get new evidence, you get new data, there's drift in the projects, and that requires you to either do some more prioritization and optimization to embed those new changes and ensure that your portfolio remains aligned to the strategy, or it may, in instances, mean that you need to revisit that strategy and change some of the elements of it, and then go back through that loop. But regardless of, regardless if you're operating in this event-driven capital allocation need or this continuous portfolio realignment, one of the key tools that you'll use for doing this is the portfolio review. And so your portfolio review is really a key moment in time to ensure that you're keeping your strategy and your R&D portfolio aligned in both of these operating models. Now, we've used the term portfolio review a number of times as we've been going through this introduction, but what do we really mean by a portfolio review? So I think if we start where organizations typically are, then what we find is that, organizations are not existing in a vacuum. They're not getting dreamed up on a piece of paper. They have an existing portfolio. They're not operating from a blank slate, but that portfolio is shaped by past decisions that have happened and by previous strategies that the organization has. And so now typically organizations are in a place where they've got an evolved strategy and the portfolio needs to follow along with that change strategy. So the portfolio review is the mechanism to enable that. And it is a structured review process that operates at both an asset and a portfolio level. And we'll describe later what we mean by the different components of a portfolio review, an asset and a portfolio level. But really it's there to help you do cross-functional trade-off decisions, really looking at your capital risk and resources. And the goal of the portfolio review overall is twofold. Firstly, it's to maximize your R&D returns within the enterprise constraints. And there are often a significant number of constraints, and we'll come on and talk about those later on. But also it's to improve your alignment between the strategy and the portfolio. Strategy becomes real when money moves, when things actioned, and your portfolio review is really your point to turn that strategy into reality.
Yeah, thank you very much, David. So, and we can't emphasize this enough. I mean, we also spent quite some time in the first webinar to really highlight and emphasize the need for these connections between the layers. And one way of assessing your portfolio review maturity is really to look at how strong are the links between the different layers, from the strategy layer or the intent layer and down to the portfolio layer and onto the project layer. And often there will be disconnects here, and then you kind of conduct portfolio review in a vacuum, isolated almost from the projects and the strategy. So that's just a helpful mental model for thinking about the maturity of a portfolio review process. And here's a bit more. You can see, and you can probably recognize some of these keywords and link them to your own organization. But here on the left, we have put what we call a fragmented way of doing a portfolio review. So it's often siloed, reactive, inconsistent, politically driven, and project-centric. So it's not really a portfolio review, but it's more like an isolated project review. And then all the way to the right, where we have what we call adaptive, where it's really, we have dynamic capital allocation. And we know there are many analysis papers out there. You can see that if a company is good at dynamically reallocating capital, it usually performs better financially and then along other metrics. So this is what is to be aspired, this flexible, dynamic way of doing capital allocation. And I saw there was a question around how often should a portfolio review happen. So let's save that question. It's a really good one, and we are right now running a survey which is trying to address that. So question is noted.
And as Simon was outlining there, one of the core components of the maturity of a portfolio review is this element of enterprise alignment. It's really critical that these decisions are made for the good of the whole enterprise rather than for just one function or one element within it. And one of the challenges we see organizations fall into is they operate with what I'd call an input-led portfolio review rather than an enterprise-aligned portfolio review. So in an input-led portfolio review, what will typically happen is that there is a single function within the enterprise who kind of leads the portfolio review, but is also kind of the only party that's present in the discussions that are happening. And other functions, such as CMC, commercial, BD, regulatory, whoever it might be, they provide input into that forum, but typically that's in the form of inputs into an ENPV model or into models like that. And that all feeds into the portfolio review. That's quite distinct from an enterprise-aligned portfolio review, where really you've got that multifunctional group around the table involved in the discussion, as well as the inputs, and coming to an aligned perspective in terms of the overall portfolio optimization and portfolio decision-making. The risk in the first model is that what can end up happening is that you end up with multiple different portfolio reviews happening in different functions. They're all kind of doing them in isolation, and you end up with strategies which don't align with each other or are dominated by one component, such as scientific evidence, for example. And this can result in critical constraints not being understood in the different reviews, and can also result in kind of discontinuity. When you've really got that enterprise view of the picture, everyone around the table, you can ensure that your decisions are really made across the whole value chain. Your capital is allocated appropriately across the whole value chain of the organization. Your trade-offs are made really explicit, and the decisions that are made are really aligned across functions and time horizons in a way that they can be meaningfully executed. And so ensuring that you've got that alignment is critical for turning the portfolio review into that mechanism for executing strategy that we want to have. So what does a portfolio review look like in practice? What are the components that normally make it up? Well, really, we would typically think about it in three broad buckets. There's some preparation activity that needs to happen. There's some decisions that need to be made, and some things that need to feed into those decisions. And then there's some implementation, so there's some actions that need to be taken on the back of the review. After all of that's happened, ultimately, then there are some consequences of those actions that then flow back and inform future reviews and future considerations of how capital and resources are going to move. So what we'll do in the next section is talk through each of these three broader sections in a bit more detail, so you can understand what we mean by each of the boxes on this page. So if we start with preparation, we can really think of the preparation for the portfolio review existing across three different domains. The first is kind of project level preparation that needs to happen. The second is portfolio level preparation, and then the third is decision preparation. So the role of project preparation is really to ensure that everyone in that decision-making body within the portfolio review has clarity over the latest assumptions that surround that project, the latest view of that project that the project teams have, but also how that project is supporting the overarching strategy that the organization is trying to deliver. So typically that project team preparation will look like summarizing key scientific changes and implications on the project development, reinforcing the project strategy and how that strategy links to the corporate and R&D strategy, and updating the project plans and latest assumptions since last governance. It's really critical when we want to have a discussion about the whole portfolio that we're in a position where we have consistency across the projects, so that we can have a meaningful total portfolio discussion. When assumptions haven't been updated appropriately and those sorts of things, that consistency goes away and it becomes impossible to have those conversations meaningfully. From a portfolio perspective, typically the activity involved is all about understanding the context in which the decision is going to be made. So this will involve summarizing the pipeline today, understanding where it is today, looking at the gap that this creates to the stated goal, the strategies and objectives that have been set out. It involves highlighting the current constraints, both capital, capability, that exist in the organization, and making sure that that's done across function and time, so that you've got that granular understanding of where the bottlenecks in the organization might be. And also, it's the role of that portfolio in this preparation to clearly articulate the shift that's occurred in the portfolio since it was last reviewed and since it last moved. And finally, the third and arguably the most important bucket in some sense is the preparation for the portfolio review and the decision making itself. And this involves outlining the current priorities, strategies, and decision criteria that will be discussed in the conversation. It involves preparing the key questions for discussion and also identifying the trade-offs that need to be considered. When having a portfolio review, it needs to be a very structured process, and this decision preparation is critical to ensuring that a meaningful discussion happens. Ultimately, if you are having the wrong conversation, then you're going to get the wrong output. And so doing that decision preparation is really critical. And different organizations will be set up in different ways. And so it may be the portfolio team that's doing both the portfolio preparation and the decision preparation. But all three of these elements really need to occur. And ultimately, the quality of the decision is determined long before the review begins. And so the quality of the activity that happens here ultimately determines the quality of the final decisions that happen.
Yeah, and before we continue, let me just quickly go over these four fundamental value drivers. So to enable the portfolio review, also the project review, we need to be able to describe our projects, our assets. And it doesn't matter what biopharma company you're in, there are always these four dimensions of risk, benefits, timing, and required investments. And they actually aggregate so we can scale up and actually put a value on each project, on the entire portfolio, and even the entire company. So just keep these four value drivers in mind.
So we've talked there about preparation. If we move on to talk about kind of some of the actual decision activities that need to happen and decision forums that need to happen. So one of the primary ones is an integrated project review. And so this is a project level discussion. Organizations will set this up in different ways depending on the size and scale of the organization, but often this can be a 2-day meeting where all of the projects come together and they're reviewed at the same time. Critically, this isn't about governance on an individual project, but is really looking across projects in a consistent way to have a discussion about the enterprise value that ultimately they are going to create and the risk that underpins them. And so these integrated project reviews typically will look at 5 dimensions for the projects. They'll look at the strategic fit of that project. So how does it support the strategy of the organization? They'll look at the value and the risk and uncertainty that that project brings. And critically ensure that that's aligned, if we take the enterprise-minded model that we described before, across the various different functions and groups. I think it's amazing how often there is actually not alignment in terms of the potential value or the potential risk and uncertainty that exists in some of these programs. And actually having the conversation about all of the programs together often unlocks different understandings of value and risk than when projects are looked at and reviewed in isolation. So one of the benefits of the integrated project review is that opportunity to see and compare all projects simultaneously. The fourth thing that's typically discussed in the integrated project review is about the resource needs for the project. So this is about what they will need in order to deliver in the short term as part of the planning period, but also in the longer term to ultimately get to launch. The more sophisticated element, which we see sometimes included in these discussions, sometimes less often, is around the portfolio effects of these projects. So this is around understanding the dependency that this project has on other projects in the pipeline, and vice versa, the dependency that this project has on other projects as well. And really understanding those portfolio effects is critical to getting a coherent portfolio picture, which we'll come on and describe shortly. the outcome of all of this process is really to ensure that we've got a consistent decision data set and that we have enterprise alignment across all of the assumptions and opportunities that these projects bring. And so once we've got that clarity, once we've got that consistent decision data set and that enterprise alignment, we're really in a place to make better portfolio level decisions overall. So that's about the integrated project review. If we move on to talk about objective and constraint alignment, for those of you that have seen one of these webinars in the past or know me personally, you'll know I'm a statistician, and so anytime anyone talks about objectives, then I'm more than happy and get excited about the topic. But really, for me, this is where the crux of the portfolio review comes from, which is around understanding the game that we're trying to play in the portfolio review. Before we can get on to prioritizing and optimizing the assets, we really need to understand what game we're playing. And by that, what I mean is really articulating what is it that we are maximizing in this review. What is the goal that we are trying to move, and trying to get that down to a single goal as possible. And typically, this might be maximize risk, adjusted EMPV, or something similar to that. Often there can be a push in organizations to have, as many different objectives, but actually prioritizing those objectives and coming up with a single primary one is often the right way to go. That objective function that we're trying to maximize, we're not then doing that in isolation. And in practice, we're doing that in a system where there are constraints that need to be considered. Now, those constraints might be budget, it might be resources or capabilities, it might be time, but being crystal clear on what those limits are, what those constraints are, is really critical. And so the organization needs to go through a process of crystallizing that objective function, being very clear on what the constraints that are being operated under are, and then articulating what are the decisions, what are the choices that we can make, which will allow us to overall maximize this function. And really, ultimately, this is what portfolio optimization is about. It's about maximizing a mathematical function, which is maximizing our objective function, subject to the constraints that we have and the decisions and choices that we have at our disposal. Now, it may be that we think about that in a qualitative rather than quantitative way, but ultimately it's the same activity that we're doing underneath. If you don't do the work of defining these appropriately, then you're answering the wrong questions. And actually what can often happen is if you haven't crystallized your objective function or you haven't crystallized your constraints, everyone can get together, have a lovely discussion, and then nothing happens at the end of it because everyone goes away with a different understanding of the game they thought they were playing, and you don't ultimately get the better outcomes that you're looking for. So ensuring that you've got that crystallization of constraint and objectives is really critical. So that's some of the decisions that we need to enable before we get on to portfolio prioritization and optimization. And portfolio prioritization and optimization is where the good stuff happens. This is where the fun happens in the process, and this is really what the portfolio review is all about. So as we come into this section, we'll start by a little bit of a thought exercise. So let's imagine that we had a pharma company, which we are calling Nexagen Pharma. Everything I should stress here is everything is made up. None of these represent real companies or real projects. But this Nexagen Pharma example has 3 therapeutic areas that they play in: oncology, neurology, cardiovascular, and they've got 5 assets currently in development across various different set of phases, various different risks, various different reward profiles as outlined on this slide. Now, we'll imagine that, Nexagen has a £300 million R&D budget for the next 5 years, and each program requires 100 million across this period. So what I'd like you to do is just for 30 seconds, I'm gonna stop talking for 30 seconds, take a look at the slide and have a think about what are the assets that you would choose to invest in if you were the CSO of Nexagen Pharma and you had this 300 million to spend. So hopefully you've had a chance to have a think about how you might go about answering that question, or how in your organization you'd go about answering that question. But if you have if you've heard what Simone and I were outlining in our strategy conversation, and what I was describing from an objectives and constraint perspective, what you will have realized is that actually I've only given you half of the problem when asking you to, in order to answer this problem. And Kelvin has identified it very nicely. It really depends on what the strategy is. I've told you the constraints, but I haven't told you anything about the strategy. And so actually, if we look at, even with this very simple strategy, even with this very simple organization of 5 different assets in the pipeline, different strategies could lead to very different choices that you could make over which of these assets you might choose to move forward with. So, for example, if the organizational strategy at the moment was to maximize value, increase the diversity across the pipeline to minimize risk, then what they might go for is Onconova, Neuralex, and Cardialis, as Valet was outlining, because they have the highest, they've got the highest EMPB, and so potentially offer the maximum value for the organization. If, on the other hand, the strategy of Nexogen was that actually they wanted to transition now to be a focused oncology player, then clearly their choice might be to go for Onconova, Oncocore, and actually not spend the additional 100 million, but look for BD opportunities to bring in the oncology space. And for you might have an organization who has a strategy to protect revenue, because there's a product which is falling off patent in 2031, in which case they might actually prioritize the 3 late-stage development assets here of Onconova, Neuralex, and Cardialis, all of which launch in a time period which enables them to support. Now, obviously, in this third strategy, if you're going for those items, you've then essentially decimated your early-stage pipeline, and so that then has longer-term implications in terms of how you're going to fill that gap in the longer term, either through BD or in internal development or whatever it might be. And for me, that's a good example of how the portfolio review process can then also have major strategic implications depending on the choices that are made. So in this toy example, we've done some portfolio selection of and tried to align that to strategy. Great, we've done a portfolio review. Well, not quite, because in practice, what we have done here, I would say, is one of the early stages of a portfolio review. And really, we can think about the maturity of portfolio reviews starting at project discussions and ending at more portfolio level discussions. And it's amazing the number of organizations that never make it out of the project-based discussions into those portfolio discussions. And really, the strategic impact and the value that we can unlock really intensifies the more mature the discussion that we can have. So at the very basic level, the most simple kind of portfolio review you can do involves a kind of a project prioritization process. So this is really a project level discussion where projects are assessed on how well they align to the strategy and the value and benefit and risk that they have, and they are given a high, medium, low score. And when this is well executed, what typically happens is those high, medium, low scores are then translated into the resources, how functional resources are aligned, and how flexible capital is aligned to programs. In cases where this isn't deployed that well, it just ends up existing as a page on a spreadsheet which says high, medium, low, and then ultimately everyone goes away and does the same thing that they were always intending to do anyway. And so that's definitely where we want to kind of avoid in this process. The next level of sophistication, which is what we started to do in the Nexogen example, is a portfolio selection discussion. In this instance, you're still having a project level discussion, but you're more actively using it to select a set of projects which align with strategy within the constraints. So it's kind of doing one pass through that function that we're trying to optimize before selecting a set which map within those constraints and deliver the maximum value. you end up with a selected set of projects and a deselected set of projects and some actions to take on those deselected projects. And some organizations will do a hybrid of the two that I've just described, where they'll have a selected set and a deselected set, and then they will ascribe a high, medium, low value to those in the selected set, which determine some of the functional resourcing, for example. Now, most portfolio reviews that we've witnessed don't really go beyond that, but the best definitely do. And the best reviews move from this project level discussion that we're describing here to a portfolio level discussion. And in a portfolio level discussion, what you're doing is you're selecting from the best choice of portfolio from a pool of viable portfolios. So in this instance, we're not selecting an individual project, but we're selecting a portfolio from a selection of portfolios, each of which has different implications on the organization with regards to the risks and constraints. And we'll come on and describe what that looks like in a little bit more detail. The ultimate goal and the top end of maturity is, in addition to that kind of portfolio level discussion and portfolio level optimization, you're also doing an operational prioritization as part of this activity, where you're identifying, prioritizing, and managing the project assumptions, risks, and inflection points, which the different portfolios are sensitive to. And so what you are building into your portfolio model is an understanding of the kind of the operational reality of how that portfolio will be deployed, so that you can make the best choice of portfolio, not just from a kind of a theoretical value risk lens, but also from an operational feasibility lens as well. And so as we increase the maturity along this pipeline of different portfolio review discussions, what we see is that there's a significant improvement in the strategic impact and value that can be unlocked. So what does a portfolio optimization discussion look like, and how is this different from a project selection discussion, as I was just describing before? Really, the key for a portfolio optimization discussion for me is that it moves the conversation from project selection to strategic identity. And one of the tools that is used as part of this portfolio review process is the efficient frontier. What you can see on the x-axis here is the kind of essentially the amount of spend or some sort of constraint that you're looking at. And on the y-axis is typically a value metric. And so but each dot on this efficient frontier represents a portfolio. So each dot represents a selection of portfolios that exists within this constraint and value framework. And so the dotted line represents essentially the optimal portfolio that you can have for that given investment. And so anything that lies on that line is an optimal portfolio. So what you can then do is within your portfolio review, have a discussion about where it is we want to, as an organization, sit on this efficient frontier. We could talk about, do we want to have a value protected portfolio where we kind of minimize our risk upside and downside, but also kind of minimize growth potential? We might have a strategic growth portfolio where we are slightly improving the growth upside, but that comes at a higher risk, but maybe managed through a diversified pool of projects. We might have an ambition portfolio, actually, where we say we're going to invest significantly more than we had intended. We're going to relax one of the constraints significantly, but in relaxing that, we're going to take on significantly more risk. Are we comfortable with that? Or we might have a focus portfolio where we are narrowing down on a couple of dependent assets, which is really risky, but if it comes off, we've ensured that all of our resources are aligned in a single way against a small number of projects. And so the key is that the real discussion here is about understanding the organizational appetite for risk flexibility and transformative value creation. This is the parts of the strategy which typically are never made explicit, but the portfolio review becomes an opportunity to make them explicit and then align the capital against those explicit domains. So that was portfolio prioritization and optimization. And then ultimately we come on to implementation. Implementation of these actions can exist at the corporate level, where it might be releasing budget for R&D more than we had, or something different. It could be at a project level, where this might be involve moving resources, starting, stopping projects, accelerating projects, these sorts of things. Or it might be at an organizational level, where this involves functions realigning against higher priorities, or selected or deselected projects. But ultimately, these portfolio reviews only create value when these decisions turn into actions. It's all nice to get into a room and have a conversation about what we want to prioritize. But ultimately, unless projects stop, unless money moves, and unless people need to realign to the priorities, then you haven't actually impacted the business. And so this points to one of the hardest challenges that come into portfolio management, which isn't about making the decisions themselves, but actually making them stick in the organization. So doing the hard work of taking the actions after these decisions are made. And so hopefully that's given you a bit of a background in terms of how we think about portfolio reviews, what some of the portfolio review maturity looks like, and how organizations are moving up that maturity ladder. With that, I'll hand back to Simon.
Thank you very much, David. Here's again mentioning the survey on R&D portfolio review practices in Biopharma. We'll leave the link here. And also, after the summer, we'll be back with the third webinar. So we go clockwise here. So it'll be about portfolio planning and how we move from uncertain forecasts to defensible portfolio priorities. And as we know, this industry and portfolio management is just full of uncertainty, and we have to take that into account as we conduct the portfolio planning. So, but we are already open for the sign up. I think we're actually out of time. If there's any burning question, I think there are already some really good questions in the chat. So we couldn't answer all of them. So feel free to reach out to David or myself after the webinar if there's something you feel we didn't cover. And yes, we will absolutely share the slides, and also the recording. We'll upload it to our YouTube channel shortly. So I think we have we can push the slides and recordings out through the email you use to sign up. So absolutely. So thank you so much, and also for the kind feedback you're providing in the chat. And with that, we'll end this webinar. Thank you very much, and have a great day.
Thanks, everyone.